Sam Burns, Chief Strategist at Mill Street Research, is here. We're talking stocks, and this is the Market Call. Welcome to the Money Life Market Call, the part of the show where we talk with experienced money managers about how they do their job, what they look for that determines their buys and sells, what they see happening broadly in the market, and how they are putting it all together. My guest today is Sam Burns. He is the Chief Strategist at Mill Street Research, which is an independent research company that specializes in developing research tools for asset allocation and stock selection and using macroeconomic indicators. And it's really interesting stuff that you can learn about at millstreetresearch.com. Sam Burns, it's great to have you back on Money Life.
Oh, it's great to be here, Chuck. Thanks for having me on again.
So I described a little bit of what you do, but there's a lot that goes into that recipe. I mean, you got some macro, you got some micro, but tell us how it all comes together, top down, bottom up, and everything else to get to where you're saying these are the stocks I want to buy, and these are the ones I don't like so much.
Oh, yeah, you're right. It's very much a top down plus bottom up kind of a picture. I really feel like you have to look at both to get a full picture of what's going on. And a lot of the clients that I talk to tend to get overly focused, I think, on either one or the other, and often miss things, frankly. So when I look at the overall market, I'm looking at market trends and interest rates and the Fed and inflation. But then I also look at what the earnings estimate trends, for instance, are doing both at the individual company level and at the industry and sector level, or even the regional level. Because really what I'm looking for is where are the fundamentals improving. It's really the direction that they're moving that's important. So if I see signs of improvement in a particular sector, and then I look in within a particular industry, and then I find strong stocks within that industry, that really tells me that there's a lot of tailwinds behind that area. And then the reverse is true. If I see things turning down, deteriorating, a lot of estimates being cut in a particular area, and then in particular stocks, then that tells me that that's an area that you probably want to avoid that's going to have a lot of headwinds. So really have to kind of put it all together that way. But I've got a lot of models and indicators that I've built over the years now that help me do that. And so I can kind of drill into whatever area a client might want to look at.
Those models, do you have different models for different economic conditions? In other words, if you think we're in a bear market, it's this kind of model. If it's a bull market, it's that kind of model. Or the models adjust to the conditions, because these conditions right now are pretty flexible.
That's right. Yeah, the models are generally the same, but some of the macro models will tell you, or at least try to tell you, whether you're in a bull market or a bear market, or kind of how much risk you want to be taking on. So that model has been bullish most of this year, but has recently kind of pulled back to more of a neutral reading lately, as kind of we've seen more volatility in stocks and bonds, and a pullback here. So that kind of tells me, you want to be really bullish, or kind of moderately bullish, or maybe you want to be, really cautious. And then from there, you go dig into the model that tells you kind of which kind of stocks and industries you want to be focused on. And that's the same model all the time, but it'll rotate and kind of tell you certain times, certain stocks will show up at the top of the list. And that gives you a clue as to kind of what kind of environment you're in. So if you see a lot of defensive stocks at the top of the list, that's a cautious environment. If you see a lot of more cyclical stocks at the top of the list, that tells you something that there's more of a positive growth environment going on.
When you are then building a portfolio with that, if you wind up having the research steer you to, I like this area, I like this sector, and steer you away from something else, do you lean into that and say, okay, I'll load up on what the research is telling me? Or do you add some art to the science and go, okay, it may love this, but I want to be more diversified. I'll take the best relative value out of the sectors that I don't like, and I won't go too heavy into the ones that the system loves.
Yeah, no, you're right. And generally speaking, my sort of guidance will follow what the model says. So it may skew towards certain sectors or types of stocks and away from others. But clients often, particularly the institutional money managers that I deal with, will have constraints like what you described. They'll say, I can't be too heavily weighted in this sector, even though the model might tell me to. So then I'll go through it. I can tell the model to spit out stocks from every sector, even the weaker ones, and find the strongest stocks within those sectors. So it can always tell you what the strongest areas are within any sector or industry or country, based on what you need to use to build your portfolio. So I often will do that. And occasionally I will kind of lean against the model if I think there's some overriding reason to do that. And there's an example right now, even in energy, we can talk about. But yeah, so I'll generally go with what the model tells me. But if a client or says I need to be more diversified, then the model will do that as well.
Well, I think my audience would smack me in the face if my next question was not, okay, what is the model like right now?
Right. So I think the message that's been coming through lately has been the relative strength has been in areas like industrials, particularly anything tied to building and construction, technology still, and technology related communication services and technology, and some financials actually. Not all of them, but some banks, insurance, and financial services companies. Those are probably the areas that have the most representation when I look kind of down the top of the list right now in terms of the highest ranked stocks based on my model. And so that's kind of where the relative strength is. And towards the bottom of the list, you're seeing things like utilities, so a lot of healthcare stocks, some of the materials companies. Those kind of areas are relatively weaker ranked right now. So I'd probably be less underweight those.
In terms of what you are avoiding right now or what have, I mean, you mentioned the take on energy and how you're kind of having the internal fight. The system says this and you're doing. Explain what's going on there.
Yes, energy's been unusual because you've had kind of the macro and the micro looking a little bit different. But in my view, oil prices are, of course, the big driver for energy stocks. And so they tend to go up and down with oil prices. And to me, oil prices have had a lot of things that should be driving them higher in terms of OPEC cutting supply, sanctions on Russia and Iran, other areas, things like that. And all those things that would normally push oil prices up. But oil prices haven't really gone up that much. And recently, you've actually seen that the prices of gasoline and refined products have come down. So the margins on refining oil have declined in the last couple of months after having been quite high for quite a while. And so you've also seen production go up outside of OPEC in areas like the US in particular. So to me, the supply demand balance, when I look at the macro level oil kind of picture, I think it looks kind of neutral to bearish. So even though oil stocks have actually outperformed for a little while last few months, particularly kind of the mid cap and smaller ones, I'm not seeing a long term picture that suggests oil is a good long term play. So some of the energy stocks do rank well in my work, but I'm kind of leaning against that a little bit, thinking that it's probably not going to last, and that there's a lot of things that are going to push oil down more than it's going to push oil up, given that all the things that have happened haven't pushed oil up any more than it already has. So kind of my macro view on oil is kind of somewhat overriding what you might see if you just looked at what the stocks themselves are doing lately. So that's one example where I kind of lean a little bit against what I'm seeing in the rankings. But otherwise, generally, commodity stocks are not doing well. Outside of energy, most of them are relatively weak. In chemicals or in metals like copper and things like that. Those are all areas that are relatively weak. So most of the commodity sector is kind of under pressure, I think. And so I don't want to go looking for oil stocks to kind of really buck the trend that much. So I'm kind of leaning against those in that way right now.
What are you leaning towards? What's a name or two that is the exemplar for here's what the system likes and I like it too?
Yeah, so a lot of these stocks that the system likes are in kind of that industrials, machinery, building products, those kind of names. So you might see like a Caterpillar or something like that be at the top of the list, or 3M, kind of another industrial kind of company that might show up near the top of the list. Carrier Global be one that would show up at the top of the list as an industrial. And then you are seeing some of the banks, which has been unusual because the banks, of course, have had a lot of volatility earlier in the year. A lot of them got knocked down, but now there's some of them that are starting to look pretty good. So you might see some of the Fifth Third or something like that, or Wells Fargo actually now shows up near the top of the list. First Citizens Bank shares. So there are some names like that maybe hadn't been strong earlier in the year that they're looking much better. And there's some insurance companies that are going along with them that a lot of people overlook. So Assurant or Chubb or W.R. Berkeley are some names that show up in the insurance sector that are relatively highly ranked. So there's areas like that are relatively strong within the financials area. Not all of them. There's still some of the weak regional banks. There's still some of the consumer related names that are under pressure, and things tied to mortgages in some cases. But yeah, there are areas of strength within industrials and financials that look pretty good. And then there are some tech names. Not all of them again, and some of them are still somewhat expensive. But technology does still look good. And technology adjacent, which includes some of the communication services that are not technically technology. But you might see like NVIDIA is still highly ranked. JBill is a highly ranked one. Comcast scores pretty well. VMware looks pretty good. So there's definitely some names within technology that still look pretty strong within the ranking. So I kind of focus on those areas that have relative strength in earnings as well as relatively better price action.
Well, now we're going to get your quick and dirty take on some stocks my audience is particularly interested in.
Quick and dirty.
I've got a good feeling about this.
Well, you should have a good feeling about this because Sam Burns, chief strategist at Mill Street Research, just explained how the research works, and now we're going to apply it to some of your favorites. This is our lightning round. We call it Quick and Dirty, where we get a quick and dirty opinion on stocks that you have submitted. And if you haven't submitted stocks, do it. Chuck at moneylifeshow.com is how you reach me. Send me your name, your hometown, and the ticker symbols you are interested in. We'll add them to our list and hope they make it into an interview soon. And Sam, I'm going to start with financials since you were just talking about them a moment ago. We're going to have a couple. The first request from Sam in Waterfleet, New York is JP Morgan Chase, ticker JPM.
Yeah, JP Morgan is near the top of my list overall and within financials. It's really the big dog there and still is. So if you want to put money into a big, safe financial, JP Morgan is probably the one to go with right now.
So that's a buy on JPM, JP Morgan Chase.
Money in the bank.
Dan in Williston, Vermont wants to know about a different kind of financial company, T. Rowe Price Group. It's ticker TROW.
Yeah, T. Rowe right now ranks fairly low on my work. So I would probably look for an opportunity to swap out of T. Rowe and some of the other brokerage type firms and move over to something like one of the exchanges like CBOE or CME, the Chicago Mercantile Exchange. Those are areas that are seeing much more relative strength in terms of earnings and price momentum in my work.
And so T. Rowe Price, ticker TROW.
Loser, loser, loser!
Yeah, that's a sell. But the winners in there would be CBOE or CME.
Sounds like the opportunity of a lifetime.
Those were buys. Greg in Short Hills, New Jersey wants to know about Meta Platforms, or what we otherwise know as Facebook, ticker Meta.
Yeah, Meta scores well. It had a big decline last year, early this year, and now it's really turned around. Their earnings revisions are rising. The stock's doing well. I would stay with it.
And so, as much as you might not want to get sucked into Facebook.
God damn it, I got sucked into Facebook.
Yeah, in this case, at least if you get sucked into Facebook, you're buying Meta and you're doing okay with it. Bill in New Orleans wants to know about Intel, INTC.
That's another one that's looking good right now. The earnings estimates are rising. Again, it had a lot of problems it's had to work through, and it's looking a lot better now. It looks like PC demand is picking up a little bit. So I would say it's a buy.
Could we please buy now?
Oh, we can buy now, and that's a buy on Intel, ticker INTC. Bill had another tech request, that for IBM, International Business Machines.
IBM doesn't look as good in my work, so I would probably avoid that one and maybe pick something in the same kind of IT services area like Akamai, AKAM, would be probably my pick over IBM.
So the buy here is Akamai, AKAM.
Come on, let's buy.
And of course, IBM, ticker IBM, was a sell.
Just let it go, dude. Count your losses and move on.
One more request from Bill in New Orleans, and that is for Walt Disney Company, DIS.
Right. Disney doesn't rank very well right now. They've been struggling and seeing earnings estimates under pressure. So if you're looking for something in that kind of space, the media area, I would go with Netflix over Disney as a buy.
And it's interesting to me, you mentioned NVIDIA. How do you feel generally about the Magnificent Seven? How did they score on your research?
Well, they were strong for a while, and now they're a lot more mixed. So Meta and Netflix look pretty good. But for instance, Apple and Microsoft are much lower ranked in my work. So some of the really big names are kind of neutral to negative, but there are still some of the Magnificent Seven that are holding up well.
So what we had in there was a sell on Walt Disney Company, DIS.
Oh boy, that sounded bad.
But in there was a buy on NVIDIA, NVDA.
Just go slow and be smart.
Our final requests today come From Richard in Chula Vista, California, the first is for PACCAR. It's PCAR.
Yeah, PACCAR is a buy in my work. It's one of those industrials that's benefiting from the construction booms and a lot of those kind of building related stuff. So I think that's a good buy there.
Yep. We're sounding the horn. That's a buy on PACCAR, ticker symbol PCAR. And our last request today, as we're getting some bonus requests in, is Flowserve Corp, FLS.
That's another good, strong industrial stock that scores really well in my work. So yeah, I would say Flowserve is definitely a buy.
And so we finish on a high note.
Bye. Is that all you can think about?
That's a buy on Flowserve, ticker symbol FLS. And, well, it was a high note throughout getting a chance to talk with Sam Burns. Sam, this was great. We'll do this again in 2024.
Sounds good. Thanks for having me, Chuck.
Sam Burns is the chief strategist at Mill Street Research. You know the name of the firm. You can find them online at millstreetresearch.com and on Twitter at millstreetst, millst research. And we'll be back to let you know where Sam agreed or disagreed with recent guests, and then we'll cross the finish line together. So stick around.